Hey, Bowtie Nation. Thanks for being here for another live stream Sunday, another Beer Money Sunday. I've got mine. Hope you got yours wherever you're at there in the nation. I've already been talking to a lot of people there in the chat for the last 15 minutes. Love seeing everybody here, here for our live streams. It's just a great way for me to connect with you face to face, a little bit more informal and close connection than we get in our regular videos. So again, thanks for being here. I'm gonna get ready and got a great video coming to you today. Trying to do these live streams every other week, every other Sunday or so. Haven't been doing it lately because we've got a huge project launching tomorrow, launching Monday, December 6th. I actually flew out to Kentucky to talk to some people, some members of the Bowtie Nation, some citizens of the Bowtie Nation, get their story, and I'm going to be including that in a series of 5 videos coming up over the next 3 weeks. And this is going to be an entire 2022 wealth creation series. Really excited about it. I'm going to start off with, creating your goals, that millionaire mindset that you need to really get started. Then we're going to progress all the way down the line. There's step by step, show you, how to create passive income, how to create a side hustle that creates that instant cash flow. I know a lot of you, especially as well as Brian and Crystal, the people that I'll be featuring, highlighting in these videos, living paycheck to paycheck, really finding it hard to make ends meet. You can't even start thinking about investing. It's really hard to start thinking about the next steps when you're still on step one, still trying to break that paycheck to paycheck trap. So we're going to start off with some passive income ideas, some side hustle ideas, show you how they did it, give you some more ideas of my own, and really show you how to start building that cash flow, building that income, so then you can move on to investing. And those last 2 videos in the series going to be how to start investing, everything you need to know about the stock market. So definitely tune in for that starting tomorrow. Like I said, we're going to be doing over the next 3 weeks, those 5 videos. Please tune into that because I think this is not only some great content, but really inspirational. Talking to Brian and Crystal, how they've done it, some of the questions they had and the fears and doubts that kept them from getting started in all these kinds of topics and ideas over the last few years, and really how it's changed their life. So again, tune in for that, and I know you'll be happy with that you did. This video, though, this cat had that huge sell-off Friday. And in fact, something we talked about last week, in last week's live stream, we talked about how we'd probably see a relief rally on Monday because, stocks sold off the Friday before so much as well, but didn't feel like the selling was quite over. So, definitely something we were looking at, and it did play out. We had that relief rally, that rebound on Monday from those lows. And then for the most of the rest of the week, except maybe Thursday, stocks were down, and stocks ended up being down 1.2% on the S&P. Tech stocks and the Nasdaq fell even further, down 2.6%. I think the Nasdaq and some of those tech stocks are now down about 7% off their highs. And of course, those growth stocks that are so popular, like in the ARK Invest fund and some of those other tech stocks, are down even more into bear market territory. In fact, last week we saw the fastest pace of hedge fund selling since March of 2020. Okay, what we're seeing is a lot of these hedge funds, a lot of the institutional investors, the money managers and that getting kind of scared. They want to lock in those huge returns they had, those positive returns they had in the first 11 months of the year. And now they're getting kind of spooked. They want to lock those in to be able to show they had a positive year and just wait for 2022, right? So that's where a lot of the selling came from. And of course, once the market comes down, then people start getting spooked, people start panicking, and they sell more, and that's just kind of a cascade and where it goes. So this video, I want to talk to you about, how bad could it get, how to invest, some strategies in there, as well as some of the things I'm watching for in this next week. Before we do get started, I want to here, what do we got here? Okay. If you do want to see the 5 biggest stocks in my portfolio, check out the link that I left in the chat there. It's actually a partnership with Motley Fool. I put together a free report, the top 5 stocks in my portfolio. These are actually the 5 stocks that I buy no matter what the market does. Great long-term plays that I know will do well over the next decade, regardless of what stocks do now. So click through that. You're going to be asked to put in your email address, and they'll send you the free report. Yeah, Motley Fool is going to send you a couple of emails asking if you want to join their stock advisor. Absolutely no obligation, though. No, it's totally free. I use the stock advisor myself because it's a pretty good offer, pretty good insight and analysis. But no obligation there. Just something to help kind of support the channel, if you click through and sign up for that, and you don't have to sign up. So check that out in the chat box there, or I will put the link in the description as well. So we're going to get to that. We're going to get to Q&A after that. And I've decided, I think, enough people have asked for it. I think I'm going to leave the Q&A section in the videos from now on, in the live stream videos. I was cutting them out, so the videos weren't too long and too hefty. But I'm going to keep those in there because I want you to be able to, get all that information we're sharing on our live streams, even if you're not able to join live on these Sundays. So we're going to get started here. Again, check out that series starting tomorrow, starting on the channel tomorrow. Great inspirational series, really, with sharing Brian and Crystal's story, as well as how to create wealth, how to build that millionaire mindset, as well as every step of the way from side hustles, passive income, and into investing. But let's get started here because I know this is something that a lot of people are worried about. Like I said, the tech stocks in the Nasdaq are down about 7% from the peak, and that's just in the last 2 weeks. So a massive sell-off in the last 2 weeks. S&P 500, the broader market there, down about 1.2%, and what's worse is I know a lot of those popular stocks there, the growth stocks, the tech stocks. Here we see the kind of a software stocks portfolio in black. The IPO ETF, which I believe is the Renaissance IPO ETF, kind of a recent IPOs exchange traded fund there. And then, of course, the ARK ETF, the ARK Innovation Fund, that's ticker ARKK there in blue. And you see what happened to these just since November, just since really the beginning of November, down 10 and 20, 25%. Actually saw a headline this week that all but 2 stocks in that ARK Innovation Fund are in bear market territory, which is 20% or more down from their peaks. So huge sell-off in those, even more so than the general market. So I want to talk about, what happened over the last week, over the last 2 weeks, where the stock market goes from here, and some investing strategies that you might be able to use to protect your money as well as make it and get ready for 2022, really. So let's talk about what happened last week. Obviously, we had the jobs number on Friday, and a lot of people are kind of trying to look at that as far as justification or rationale for why stocks crashed. And we did see a huge drop from what was expected. So here we go. We got, it was a gain of just 210,000 jobs in the month of November, despite the estimates for almost 550,000 jobs. Okay. No, that was, so expectations were 573,000 this month. Last month was 546,000. So a fairly strong jobs number last month. And then just 210,000 created in November. The unemployment rate did fall quite a bit, though, down to 4.2%. We had labor force participation increase, which has been a real sticking point, over the last several months. So was that the reason why stocks fell? What does the jobs numbers say about the economy? And it was a really weird survey if you really look into it. And this is actually what I did for 5 years as a labor economist for the state of Iowa. I looked at this kind of stuff, and I helped put these surveys together. And what we saw is that business survey. So what they do in that employment report each month is they survey businesses. They say, okay, so how many people have you hired? That kind of thing. How many people got laid off? That kind of thing. But they also have a household survey where they survey households that say, okay, what, did you get a new job over the past month, and that kind of thing. And they really differed. That business survey, we saw the 210,000 jobs created, very disappointed because it was so much lower than what was expected. But the household survey was about what was expected. It was over 500,000 jobs created in the month. We also saw huge revisions, about 82,000 jobs added to prior months, okay, because they get more information and they get more data in, and they revise those prior jobs reports after the fact, in the coming months. So we actually saw, jobs increase from those prior 2 months. So I wouldn't really take this month as, at face value. Unemployment was down. The participation rate was up, which again is very positive for the economy. And there's a lot of seasonal factors that go into that jobs report that can kind of skew the numbers. So it probably really wasn't the jobs report. And now, if anything, the jobs report is just saying that the economy is fairly strong. The unemployment rate already down to 4.2%, which is getting very close to where the Federal Reserve likes to see it before they start raising rates. So what was it? Was it the Omicron? Okay, like we said, like I was talking to somebody in the chat before we started here. The Omicron virus is now in 15 states. Okay, that variant is found in 15 states in 35 countries, and there is no doubt that this is going to be a Delta level surge over the next few months. Okay, we are getting into that period of the year where people are going to be inside the house all the time. They're going to be transmitting this thing a little bit easier than they would if they were outside, and there is going to be a surge over the winter. So it's easy. It would be easy to say that the market is selling off on fears of a virus surge because obviously this Omicron, it's looking like it's going to be more transmissible, not necessarily more deadly, but more transmissible from person to person. The vaccines that we have and the treatments might not be quite as effective because it has mutated a little bit from the original strain. But if you look at the stocks that really did well and the ones that sold off this week, it's kind of hard to make the argument that it is an Omicron-led drop-off in stocks. Okay, if you look at some of those lockdown stocks like Zoom, Zoom, DocuSign, Etsy, a lot of those stocks that did really well under the lockdowns last year, they all plunged versus some of the big tech names. Okay, so they all plunged this last week. So I think investors are saying that yes, we might get a surge from Omicron. COVID cases are going to be going up, but they're not going to see those lockdowns. We are not going to see the lockdowns just because the place that we're at with vaccines, with treatments, it is much less likely that local governments, national governments, that kind of thing, are actually going to go back into that lockdown mode. Not necessarily Omicron led. Now that's not to say that we might not get some more weakness from that surge. Okay, like I said, there's no doubt in my mind that we are going to get a COVID surge over this next few months as people stay in and are transmitting that a little bit faster than if they were outside. From this Omicron, eventually, we will get a variant or a strain of COVID that will be more resistant to vaccines. So we'll need more boosters. We'll need a whole new vaccine, that kind of thing. What this sell-off this last week was, and the week prior, it was more a function of Chair Powell's testimony to Congress on Thursday. If you go over the notes on that testimony, what he said during that is he actually finally came out and said the inflation picture that I've been arguing for the last few months is not as temporary as he thought. He actually came out and said he dropped the word transitory about inflation in his testimony. Over the past year, the Fed and a lot of economists have said that, yes, inflation is growing, it's higher, but it is transitory, right? It's going to be temporary. Well, he actually dropped that, and he actually came out and said that transitory isn't the right word for it. He still believes that there are some pieces of inflation that are temporary, that are going to be fading out, like from the supply chain issues and some of those other things. But he also did admit that inflation is here for a while, and it's going to be here for a while, and it's going to be a problem. So he did say that the Fed is going to start talking about raising rates and tapering a little bit faster here in December when they meet on the 10th of December here. And that spooked the markets, because I love this analogy. I was thinking of an analogy for this, and it's really kind of like the market has been drinking espresso over the last 2 years. Okay, the market investors have been high on this espresso rush over the last 2 years, drinking 3 cups of espresso every day. And even anytime, okay, any of you coffee drinkers out there, if you're on espresso, you start drinking regular coffee, it just ain't gonna do it. You're gonna come down. And I think that says a lot about the market right now. Investors have been high on these market returns over the last 2 years. It doesn't take much. All you got to do is to look at any stock chart to see that something is just a little out of the ordinary. We can look at I think the ARC is really the best example of this, and this is something that we've been talking about for the last couple of months here. You look at any stock chart over the last 2 years, and it's obvious that something broke. It's right here, right around March, April of 2020, right around when that stimulus started being pushed out. The ARC Innovation Fund went from right around $45-50 a share all the way up to $137, so almost 3 times that in less than a year. January of this year, it hit those peaks. And you look at just about any of those growth stocks, really even the market in general, even the Nasdaq or the S&P had these huge jumps. So investors have been high on this, on this caffeine rush of stock returns, thinking that stocks are going to go up 20 or 30% every single year. And as we head on into 2022, as we start seeing the potential, the possibility that stimulus and those low rates get taken off faster than expected, then it's like switching to coffee again. 2022 is still looking like a good year economically for corporate earnings. Economic growth still expected to be right around 3 to 4%. Corporate earnings growth is still expected to be up towards double digits, 9 to 11%. And so that's fairly good corporate profits growth, right? So that should support stocks. But when you look at a year where corporate earnings rose 30% year over year, then it leaves something to be desired, right? So that's really what I think is coming, is happening here. People saw that testimony by Powell, when even the holdouts like Powell, like some of these economists start saying, okay, inflation is higher than normal. We need to start, tapering faster and raising rates faster. It's going to slow down the economy, and it's going to slow down corporate earnings, and people start getting spooked, especially in these expensive growth stocks, these tech stocks that have done so well over the last 2 years. So that's really what we saw. So the question is, how bad can it get? Should you buy the dip? Should you jump in here now, or should you wait a little bit? Now, what I'm thinking here is this is not going to be like March of last year. Okay, we are not going to get a stock market crash unless you're in some of these growth stocks. Again, if you're in some of these very expensive growth stocks, tech names like in the ARK Innovation ETF, that ARK-K, then you're already in bear market territory. You're already in crash mode because some of these stocks are down 30, 40, 50%. But in the general market, in the overall market, in the Nasdaq, in the S&P 500, and in these regular, these bigger tech stocks and stuff like that, we're not going to get a 30% drop, right? You don't get that in a year where the economy is still growing by around 4 or 5%, while corporate earnings growth is going. We've still got households and corporations sitting on a mountain of cash saved up over the pandemic. So you've still got some really good support for stocks and for the economy over the next year. But that doesn't mean we're done. But we're done selling. Like I said, a lot of these hedge funds, a lot of these institutionals and money managers, they're getting spooked. They want to lock in their 2021 returns so they can book that positive year and then just wait it out. So you're not going to see a whole lot of buying from those from those big money players over the next week, over the next 2 weeks. I think that's going to spook a lot of the market, and you could get another week or two down. I think it's going to turn out to be a lot like we saw a couple of years ago. I think it was 2018. If you look at 2018 did very well through most of the year. Then right around December, early December, stocks plunged. They were actually down, I think, almost 18% at one point. And then right around mid-December, they started to pull back up again. You started to see some buying interest. I think that could be very similar to what we see this year, just because, again, people are taking their money off the table. They're trying to book the positive return for 2021 and just wait it out. But then, towards the end of December, they're going to start thinking, okay, you know what? I want to buy at these low prices. I want to buy the dip before everyone else does and send those stocks back up. So I think, mid-month is when you probably start seeing some buying interest there. How far it goes, how low stocks go, again, is going to depend on really which stocks you're investing in. Okay, if you're in the market, if you're in the broader market, the S&P 500, even the tech stocks in the Nasdaq, you still might only see maybe another 2 or 3%, and then you can start buying in at that point. And I'll talk about an investing strategy to actually time that and which levels to jump in at that point. But then again, if you're in those growth stocks, if you're in Teladoc, if you're in Zoom, if you're in Etsy, things like that, those stocks that have sold off but are still pretty expensive on that price to earnings and price to sales basis, then that it could still get worse. It could still get another 10 or 15% worse, in fact. So you really have to watch that. What should you be buying? What should you be looking at? I think, if you just look at last week and the last couple of weeks, I think you saw big tech hold up really well. So your technology stocks like Apple, Intel, HP, those large diversified technology companies, even IBM did well, okay, against some of these. I think you can look at some of your long-term holdings. Myself, I've been adding shares of PayPal and CRM, so Salesforce.com. I've been adding shares of those just because, yeah, they're a little bit expensive still. There's still some of that growth stock feel, and they could sell off a little bit more than some of these other big tech names. But I'm in it for the long term. I'm in it for the next 10, 15, 20 years, and I think those are some great companies to look at over that time. But anything has to be kind of that stepped strategy that we're going to talk about it and that we talked about last week, right? You have to set how much of your cash you're going to use at certain points so you're not buying in at every single dip. I see a lot of people that every time the market falls on a day, they say, okay, should I buy a dip? Or they're buying on that dip, even when the market is down 1% a day or 1.5% or anything, they're buying the dip. And what happens is by the time the market's down 10% or 8%, they're fully invested. They've got no more cash to invest. And if the market keeps falling by another 15 or 20%, then they're kind of SOL, right? Because they've already committed all their cash into that dip. They're fully invested. And so I don't want you to be at that point. I want you to strategically think about this, when you're going to use that cash, and how you're going to buy on those dips, and we'll talk about that in a little bit. Cryptocurrencies, Bitcoin, Ethereum, a lot of those got slammed over the weekend, but I actually took advantage of the big sell-off over the weekend to buy more Bitcoin. Bought it in at the just over 47,000, just under 48,000. And what we saw over the weekend really is what we've seen in the past. Anytime Bitcoin or some of those cryptocurrencies fall more than about 9 or 10%, it starts triggering those margin calls at these platforms. A lot of Bitcoin investors are very much over leveraged. They're buying 5 times more Bitcoin than they actually have in the account, right? Maybe they have $1,000 in the account. They're buying $5,000 worth of Bitcoin to leverage up those returns. Well, what happens is when Bitcoin does fall, it works the other way as well. If you've got 5 times your leverage in your account, if Bitcoin goes up 10%, you've made 50%. But if it comes down 10%, you're down 50%. And that's when those margin calls start going out, is when the sell-off gets really bad. Over the weekend, obviously, people aren't able to add to their account from their banks because the banks are closed. So it's just kind of forced selling, right? People get those margin calls. They can't add money to their account. So the platform forces them to sell some of that Bitcoin or some of those cryptocurrencies to cover that margin call. And that's what we saw Friday night. When it hit that 10%, it plunged after that down to about 22%. It's really supportive that it's built back up since then. It's back up to, Bitcoin's back up to about 49,000, right around there, from a low of 42,000 Friday morning, Saturday morning, as it were. Ethereum's back over 4,000. So it's really constructive that it's being able to build back after these big drops. Usually in the past, we've seen it hits these big drops and everybody just panics and the selling begets more selling, more selling. But what we've seen over this past weekend is that, and I've actually seen news or analysis on it that maybe it was a little bit more manipulative, right? Some of these big money holders sold all at once, just to try to kind of crash the price, try to force out some of these leveraged buyers so they could get a better price. And they bought back in after the crash, and that's what's forced the price back up. So we're not seeing the massive sell-off with the long-term investors like we've seen in the past. Another upside to cryptocurrency, and something that really is the reason why I've become a long-term investor over this last year, is just the momentum of adoption and the inflow of investor dollars into Bitcoin, into Ethereum, and other cryptocurrencies is just really supportive over the long term. I'm not worried about a 10 or even a 20% drop in a single weekend. I'm watching the 3 or 5-fold that the cryptocurrencies do over a year, over 5 years. Okay. One quote that really struck me over the weekend or over Friday was Eric Balkunas, an ETF analyst and over there at Bloomberg Intelligence, talking about whether an ETF is approved for Bitcoin or not. Advisors are going all in on crypto. The pressure on advisors is just boiling over, he says. This is a direct quote. The pressure on advisors is boiling over. A lot of advisors feel like they have to do something to service a client base that's demanding crypto. Okay, so what we're seeing is that even some of these skeptics, even some of the old school advisors, money managers that, are just saying, hey, I'm not touching crypto. I'm not putting my clients in crypto. I don't know what it is. I don't understand it. So I'm not even going to touch it. A lot of those skeptics are being forced, kicking and dragged, kicking and screaming into crypto to satisfy their clients. The clients are saying, hey, whether you believe in crypto or not, I believe in it. I want to invest in it because it's up, 300% in the last year. So I'm going to invest in it. If you're not going to let me invest in it into my accounts with you, I'm going to go to another advisor. So a lot of advisors are being dragged into this. A lot of institutional managers, things like that. Case in point, Jamie Dimon, CEO of JP Morgan, largest bank in the world, right, has been one of the biggest crypto bears, says it's worthless, says there's no value in it, says he doesn't understand it, all this stuff over years and years, right? But guess who is offering crypto services, crypto holding services to its customers? JP Morgan, right? So, if he really felt that strongly that there was no value in cryptocurrency, that he didn't think people should invest in it, then he's actually got kind of a duty to keep his clients from investing in it, right? JP Morgan shouldn't be offering crypto services if, all the management at the top thinks this thing is a Ponzi scam or has no value whatsoever, right? But even JP Morgan, is being forced because of client demand, because of investor demand, to add cryptocurrency services and that kind of thing. And so that's just adding to this momentum of adoption for cryptocurrencies. It's becoming a legitimate asset. And, at today's prices, 49,000 on Bitcoin, 4,000 for Ethereum. I'm not one of these people that's going to put a price or a forecast price on it, but it could be it's going to be much higher over the next few years. So one of my largest conviction plays. So what to buy as far as in this sell-off. I think you do well with big tech. I think you do well with cryptocurrencies and some of the safer plays over the next couple of weeks. Now I want to talk a little bit about what I'm watching over this next week, a couple of the stocks I'm watching, a couple of the economic data, and then we'll get into that question and answer session, which of course is always my favorite because I can go back and forth and kind of just talk to you out there in the nation. Now, one thing I think is going to weigh on the markets, probably the biggest factor that is pushing me to be a little bit more bearish this week, and maybe as we start seeing a little bit more buying interest over the rest of the month, but definitely this week, is that the CPI, the Consumer Price Index, is out on Friday. That's the big monthly inflation number that we get, but it's not out till Friday. A lot of times that'll get released on Tuesday or a little bit earlier in the week, because it's not out till Friday. The market just kind of has to sit on its thumbs and wait, okay? And so, of course, with Chair Powell's testimony last week about inflation really spooking the market, next week we have to wait until Friday to get more confirmation on that number, on that inflation data over the last month. I think the market is really going to be on edge until then. So you're going to see a lot of volatility. You might again see another relief rally, another rebound on Monday, but from there, Tuesday, Wednesday, Thursday, I think are going to be very weak, and you could see further sell-offs through that. As far as what's expected on that inflation data on Friday, it's expected to be 6.7%. Consumer inflation is expected to have risen 6.7% over the year to last month, which is crazy. It's another multi-decade high. Okay, we haven't seen this kind of inflation since the early 80s, just after that stagflation that we had in the 70s, and rates were much higher. And then so two factors that could really spook the market this week is just the weight leading up to that inflation data and the inflation data itself. If it's anything over 6.7%, which it very well could be. Last month was 6.2%, and it did spook the market. It did kind of start the market caution and the market jitters. Anything over 6.7%, I think, could be very scary for the market, and could extend this sell-off. And again, just as Chair Powell is now admitting that this inflation is not transitory. It is not temporary, something we've been talking about on the channel for quite a few months now. If you look at rent is starting to go up much higher than it has in the past, just because it's catching up with those home prices. Rent is 30% of the consumer price index, of this index that we'll see here on Friday. And I think that rent increase is going to start pushing this index and start pushing that inflation even higher than expected. So be watching for that Friday. Know that that's probably going to mean a weaker market for most of the week. Some of the stocks I'm watching on throughout the week, still some earnings coming in. Stitch Fix, okay, Stitch Fix earnings are out on Tuesday, and this is a kind of a crazy one. We can actually go and see here in the here in the stock page on Yahoo Finance. And if you look at this, it was almost exactly a year ago, about a year ago, that or a little bit more than a year ago. It was here in 2020 that I recommended Stitch Fix on the channel. It was right around where it is now, right around $22 a share, and it boomed. I mean, it was one of our best stocks of over the last year. It boomed up to $95. Actually hit 113 as the 52-week peak on that, and has since just crumbled back down there. So if you weren't in it before, if you didn't get out, at that $95, it's hard not to take a it's hard not to take a five-fold return, on one of your stocks. But if you weren't able to get in, or if you stayed in, then I think actually it's right about the point where I would start buying back again. We've seen a lot of these digital retail stores, these apparel stores with that digital component, with a strong digital component, have been doing really well over this earnings season. Okay, so that's one thing. A Stitch Fix could surprise on the upside, just because it is a digital e-commerce retail company. As well as now it's down to a price to sales of just 1.3 times. It's growing its sales at a good clip. So I think now it's actually back in value territory, which is what I was looking at over a year ago when it was back down to this level. It is in value territory. It's a strong technology-driven retail company, which obviously is something you want to see in the industry right now. So I think that's something you look at. And again, Stitch Fix reports earnings on Tuesday. Another one I'm looking at is ChargePoint. And all you EV investors, all you investors in electric vehicles, are going to be big into this one. ChargePoint Holdings reports on Tuesday. That's ticker CHPT. And you see the stock here. Down big on Friday on that sell-off with the expensive names, with those expensive growth stocks, but still down more than half. 52-week high was right around $50 a share back there almost a year ago today in December. Now down to $21.57. And I think this is another one where, it's a great long-term buy. It's only a $7 billion market cap at this point. At the peak there, it was well over $15 billion market cap. Pretty expensive on all the valuation measures. But if you're believing in the EV theme, then this is going to be the stock to buy. I think there aren't going to be much sales to report. It really doesn't have much sales of any, to report. But I think what happens is very soon a lot of these charging stations, these companies like ChargePoint, start talking about that infrastructure deal. Okay, there was a lot of money. There was billions of dollars of money in the infrastructure bill that was already signed and is going to be going out over the next year. There's a lot of money in that to start building out the nation's infrastructure of charging stations. Okay, and I think some of that goes to ChargePoint Holdings. I think they benefit from that. They start talking about that in their earnings reports or releasing it as news announcements, and I think that's going to be a big boost to the stock from here. So, not saying that the stock couldn't still get hurt a little bit. It's still fairly expensive on a price to sales basis, and since there really aren't any earnings, you can't do a price to earnings basis. But the valuation has come down quite a bit from earlier in the year and last year, and I think this is at one point where, if you're bullish on the EV side of things, and I think you should be, then this is definitely a stock you want to be in. You want to start building up your position. UiPath, another one, last one we'll talk about before we get to the Q&A section. UiPath, ticker PATH, reports Wednesday. It's down 37% from the IPO. which was only just this year. It's one of those very expensive growth stocks that IPO'd over the last year that has just been slammed, but it's still 34 times sales. The price of this stock is still 34 times its annual sales. So these names have been crashing hard on third quarter earnings. I would watch out if I was in this stock. I know it's hard to take a loss at a stock that you've been in for a while. If you were in it since the IPO, it's down 37%. But all of these stocks, all of these growth stocks, these very expensive tech names that have been reporting third quarter earnings, a lot of them have been down big on the day, when they reported. So I'd be watching for that and maybe covering your bases on that. Now I want to switch it over to the Q&A section, or the Q&A portion of the live stream. Obviously, my favorite part of the live stream. I love talking back and forth with you. So I'm gonna scroll through the chat here, see what questions you have. Go ahead and ask your question again if you like. If I don't see it, make sure you use that question mark so I know that it's a question and I can see it a little bit easier. So Mark got a list of names here: Tesla, Nvidia, Apple, Nike, Square. A lot of these kind of big tech names. A lot of those big tech names have done better over the last week. So I think those will continue to do better. Some of the more expensive ones, Tesla, Nvidia, those might sell off some more. But he's got some diversification here with Boots, with Walgreens Boots Alliance, Morgan Stanley, Disney, some PayPal. So he's got some diversification in there that should protect you from the worst of it. Ivan, good to see you, man. Thanks for that 400 ruble. Appreciate that. Say I'm a legend. I appreciate that. Maybe a legend in my own mind, but we won't get into that. Have you ever been watching more of the year and every time you prove it? Okay. Also want to know, what are your thoughts on BTC next few weeks, and do you think big fish will try to manipulate more? I think for right now, the institutional players are probably done manipulating Bitcoin and some of those cryptocurrencies for right now, just because they've got that leverage shakeout. Okay, so what we were talking about earlier is, and it's hard to, I'm not one that usually talks of conspiracy theories, right? It's really hard to believe that they would be able to get enough money together to really manipulate a market that size. Okay, what's so $3 trillion total cryptocurrency. Bitcoin is about 40% of that. Ethereum's another, I think it's around 25-30%, but just Bitcoin alone. So 40% would be, about $1.2 trillion. So it's hard to imagine that they could amass so much selling that would push it down 10%, right? Push Bitcoin down 10% on a $1.2 trillion market cap. But it's possible. That's exactly what we saw with George Soros back there when he broke the Bank of England, right? He actually, everybody hears about George Soros that did it, but it was actually a team, a consortium of banks and traders that helped him really force the pound down lower with forced selling. And really, broke the pound, broke the Bank of England. So, these kinds of market manipulations are possible. They do happen. And I've heard a lot of talk that might be what happened over the weekend here. And what they're trying to do in Bitcoin, in cryptocurrencies, like we talked about, is kind of force out those leveraged sellers temporarily. Anyway, they're trying to force that forced selling on those margin calls, drive the price down as much as they can so they can get back in. And, a lot of times what you'll see is kind of buying in the, kind of hedging in the futures market, right? So, these big money players will short futures contracts, right? So they know they're covered. And then they'll start selling their own Bitcoins, their own cryptocurrency to force the price down. So they don't necessarily lose very much as the price goes down, because they've got these short futures contracts. That forces the price down. That forces a lot of this margin calls and this forced selling on the retail side. And then they can just go back in. They buy back their futures contracts at a gain, at a significant gain, and then they buy back the Bitcoin, which of course pushes it back up. And that's what we've seen. We've seen Bitcoin rise back up from about 42,000 back up to 49,000 now. We've seen a lot of volatility and a lot of the volume fall out, And so they really achieved what they wanted to. A lot of the leverage is out of it. So I don't think we see over the next couple of weeks at least any more of this forced selling, this market manipulation in Bitcoin. So if you're in it, short-term trading, that kind of thing, I think you can be a little bit more supportive on the price, because there isn't quite as much leverage to be forced out and to push those prices down lower. I generally I generally try not to talk about Bitcoin over the next few weeks. You look through Yahoo Finance and there's no shortage of, oh, well, if it keeps this level, it's going to 55, or if it drops below this level, it's going to 42 or 10,000 or whatever. And nobody really knows. I mean, come on. If anybody knew exactly where Bitcoin prices were or had that technical analysis down to a T, then they'd be billionaires and whatever. But so I don't know that anybody really knows, over the next 2 weeks or 3 weeks where it's going. Again, I'm supportive of the price just because we already saw a lot of the forced selling. We saw the leverage come out. And typically after that point, then, once you force the sellers out, once you force a lot of people out that didn't want to sell maybe, then you're pretty much at a good base, and you can start building on from there and going higher. So, short term, I'm supportive of the price. Long term, I'm very supportive of the price. I still think Bitcoin gets at least, up to the all-time highs, in early next year or even sooner. I'm waiting for right around 85, 90,000 at least before I even think about selling or even think about any kind of a selling strategy. Okay, so great question there. And again, thank you for that. Thank you for that super chat. Let's scroll up here and see what we can see for as far as other other questions. Get some more go juice here. Okay, can't beat the Bay. Says fintech in general is a great play. ARK F is a solid start if you just want an ETF. A lot of these ARK ARK funds, the innovative new tech kind of funds, they're starting to look even more attractive. Yeah, you're right. They've, like I said, I think all but two of the stocks in the ARK Innovation ETF, the ARKK, are in bear market territory. So they've sold off quite a bit. I would caution you though, if you look at the chart on any of these stocks, even though they have sold off 30, 40, even 50%, they're still, upwards of 50, 60, 70% above where they were in 2019, before the pandemic, before all that stimulus buying and all this stuff happened. So, it's not to say that they couldn't go further down. They couldn't go further into value territory. So I wouldn't be jumping in all at once with these. I still think, obviously, as the Fed pulls back on its stimulus, starts tapering faster, eventually starts raising rates, you still have a lot of that uncertainty, that weakness in that side of the market that is going to weigh on those stocks. Okay, what else we got? So Ivan says micro and camera is great. Yeah, just started using this camera. Finally got it figured out how to connect the camera directly with the with the computer and live stream from the camera. So I'm gonna be doing this more. Hopefully, be getting more videos out to you, more timely news centered videos. So definitely be watching for that. Got my drink and football in the background. Yeah, it's hard doing these live streams during football. I want to be in front of the TV, in front of the Bucks too. Actually, probably getting ready to move to Tampa here in a few months. So I'll be sitting there in the stands with you watching the Bucks. But until then, it's beer o'clock where I'm at. So what else we got? We got trying to find questions here. Again, if you ask a question, make sure you use a question mark so we can see, so I can see that real easy. T, buy the dip, yes or no? Okay, so Clayton wants to know, buy the dip in AT&T, yes or no? And this is actually something we talked about last week. Actually, I did buy some AT&T last week. I bought it. We were talking about it last week, and I did buy it. I think it was like Monday morning or something that I bought AT&T shares. I think it's down into value territory. If you look at this, a lot of fear is built into how much are they going to cut the dividend, but even if they cut it by half, it's still a 4% yield. Okay, even if they cut the dividend by more than half, it's still a 4% cash yield, which is like 3 times you get on the overall market. Overall stock market is paying about a 1.3% dividend yield right now. AT&T is at just over 8%. And we can actually check that out. But But so even if they cut it by more than half, it's still paying 4%. I don't think they'll cut it by quite that much. It's at 8.9% right here. Okay, so AT&T dividend 8.87%. Even if they cut it by half, it's still 4.4%, which is more than 3 times over what you get with the rest of the market. Price has come down on this thing. Hell, over the last 5 years, it's just plunged. But if you look at valuations on this thing, and this is something we actually talked about I want to say last week in the live stream. I had some data to show on it. But price to sales 0.95, so it is selling under how much they make on a yearly basis as far as earnings. More importantly, I think is if you look at what's really hurting this stock, what's really hurting AT&T is cash flow and the debt. Okay, so we saw a big drop in cash flow this year. If we look at the cash flow statement, and I know everybody loves to look at the income statement, loves to look at earnings and all that kind of thing. Cash flow statement, this is where you want to be. This is where I went blind over my years as an analyst doing cash flow analysis, because this shows the true cash generating power of the business. And what we saw here is, one of the things that's holding the stock back is that $27 billion they spent on, on investing this year. $27 billion they had to plow back into the company. Really hurt their, hurt the cash flow. That's why they're cutting the dividend, and it hurt how much they could repay in debt. And one of the other things that we'll talk about, $27 billion they had to spend in investing, this year. Well, the reason was they're ramping up for this 5G explosion in service. And what we saw was that 5G bandwidth, the auctions for that was tremendously expensive. Okay, so what we saw is all these carriers, AT&T, Verizon, all those, they had to pay a bundle of money to get these 5G bandwidths to be able to use their services on. That's over. They're paid now. So what you're going to see is this cash flow, this investing cash flow over the next year or 2 years is really going to stabilize. It's really going to moderate. That's going to mean they're going to be able to plow more of that operating cash flow that's still, making $40 billion a year in just operational cash flow. They're going to be able to use more of that to pay down the debt, which is obviously, the other big thing about this company is they've got so much debt. They've got basically debt to equity, I think, of more than 2 times. And it really worries the market. Anytime a company gets that much debt, obviously it was, fueling that acquisition boom. They bought all these companies that they didn't need to buy, got way in over their head in debt. And, they were only able to pay off about $2 billion in debt over this last year because that investing needs, the bandwidth needs was so high. But like I said, what we're going to see here over the next year, you're going to see that investing cash flow go down. You're going to see the debt repayment go up. You're going to see cash flow stabilize. And I think it's really going to be supportive of this stock because now, they're going to cut the dividend. It's still going to be a 4% plus yield. And still going to be a 4% plus yield. Cash flow is going to improve. Debt's going to go down. And I think you see this is probably where the lows of this stock is going to be, right around $20 a share. I think you add more of this stock going forward. And, it's not going to make you rich. AT&T is never going to make you rich like some of these other growth stocks will. But, it's hard to beat a 4% dividend yield plus maybe a 5 to 10% or even more, 10% price appreciation yield annually over 5 years. It's hard to beat that. It's hard to beat a 15% return annually on a stock. What else? I just missed a super chat. I know somebody sent that in. I'm gonna scroll down and see where that was. If I can. Okay, here we go. MM Martin, $5 euro super chat. I appreciate that. Thank you. A few growth stocks in my portfolio: HIMS, Skills, Open Door, SoFi. Just wondering, as I'm a long-term investor, should I be worried? I haven't really looked at a lot of those. I know Open Door is more. I'm more positive on Open Door since Zillow jumped out of that market. So Open Door obviously has more of a market to buy those houses, which is what it was doing. SoFi, I've worked with them in the past, and they're a really strong fintech company. The problem with a lot of these is, they're just so expensive. They're just so expensive on a long-term basis. Since you are a long-term investor, I don't think you should get worried. I know it's hard to say that and then watch the stocks drop as much as they have. I mean, we can look at SoFi, and I think I looked at this over the past couple of weeks, just because it is a really strong fintech company, and I think they're going to be in that digital wallet space that I'm so constructive on over the next few years. But hell, 7.5% down Friday alone. Since its peaks in November, it's down. About 25% or more down from 22. What I like about SoFi, and yeah, I do remember talking about this last week on the live stream, is you see these peaks. You see this strength every few months. Whereas you look at some of these other fintech, these other growth stocks that have really been smashed all year. You look at, and they peaked right around January, February. And it's just been a one-way trip all year. Okay, it's been one way straight down all year for these stocks. Whereas SoFi, I mean, you still do get some positive news and positive support on the stock. So that is one thing to be positive on the stock about. And I'd have to go back and see where this came. I would guess this is right around earnings that the stock is getting these big bumps here. Where you see, so May probably the second quarter earnings report. January, February, March, April. So that's actually probably the first quarter earnings report in May there. And then this is probably the, maybe the second quarter report. This came out, early October, and is really, re-energizing the support on that stock. And so that's supportive. That's supportive when a stock, even if it is overvalued, even if the market sentiment on those kinds of stocks are against it, even against that, it can still head higher into these peaks. So that's supportive. It is still expensive. I looked back. It's still trading at 15 times on a price to sales basis. Obviously, further down from where maybe where you bought it or where it was earlier in the year. Still an expensive growth stock, but if it's growing sales by, and we'll see here, 34% isn't a huge growth rate, but it's still very strong. It's still strong on a almost $900 million in annual revenue, growing that at 34% a year. So I think SoFi is one that you can hold on to. Definitely, it's one I like. I would rather it be down around 10 times on a price to sales basis. That's just kind of where I draw the line on a lot of stocks. But then again, I'm a value investor. Okay, it's very hard for me to pull that money out and buy anything that's over more than 10 times on a price to sales basis, just because I'm such a cheap ass. Okay, so don't take my word on growth stocks all the time. I think you can still invest here in some of these and be very happy. Again, definitely over the long term on something like that. Okay, Martin or Martano wants to know about gold. What about gold? Gold is a tough one. Gold should be getting more support through, from these inflation fears. But what we talked about over the last couple of weeks is gold is already pretty expensive, and we can look at the price chart. And this is something we've been talking about. If you actually look at the returns on gold since, even over the last 30 years, all the way since the 80s, if you look at the price return on gold, that's around 7% annualized over like 3 decades, which is really high for that kind of a commodity, for that. So what I'm thinking here is that, yes, gold does get support from inflation, and we've seen that this year. The price has been supported, so it hasn't fallen more from this peak that we saw just last year, right? Just last year, that peak of about 1962, right around $2,000 an ounce. It has been supportive, so it hasn't fallen further, but it's got some real tough times going higher, right? Because it's already fairly valued, fairly highly valued. One thing you got to understand about gold as well is that it is very sensitive to interest rates. Okay, so while inflation does support the price of gold, it does support the value of gold. Interest rates hurt the value of gold. Okay, because while you're holding gold, you're not earning any kind of a yield. You're not earning any kind of money. While you're holding gold, it's a cost to it. So as interest rates go up, people start thinking, well, you know what? I can invest in bonds. I can invest in something else that is going to earn me that higher interest rate. Okay, so as interest rates go up, it tends to have a limiting effect on the price of gold. And that's really a lot of what is driving the markets right now, is that outlook for higher interest rates next year. And so even though we do have higher inflation, much higher inflation, It's holding gold really steady actually over the past year. It's been in that range. We've talked about a range for gold here, right around 1750 to 1900. Where it'll see those bumps back up to 1900 or close, and then it'll fall back down to this support right around 1780 where it is now. So if it falls any lower, if it falls down to maybe the 1750 level, I think you can get in. But it's going to be limited. It's going to be limited for as long as we're worrying about interest rates going up. If you are, in this kind of inflation theme, I think you probably invest in other things instead. I think you invest in maybe the gold miners because they're all in sustaining costs. So the price that it costs them to dig this out of the ground and to sell it is much lower than this 1800. So they're still making money. Even if gold stays at 1800, they're still going to make money. They're still going to release those dividends, and you're going to get a good return on that. Some of the other inflation hedges that we've talked about on the channel, obviously, things like cryptocurrency, things like Bitcoin, not necessarily a one-for-one inflation hedge, but over the longer term, a pretty decent investment. Other inflation stories that you want to look at is, other commodity prices, energy stocks. Financials do really well with higher interest rates, higher inflation, because the banks are lending out that money at higher rates. So that's one thing, that kind of a theme that we've looked at over this last year is those energy stocks, the financials, especially as a hedge against higher rates and higher inflation, which is going to hurt a lot of the other stocks in your portfolio. Okay, Tony wants to know how big of a Santa rally, if we get one at all, right? Santa rally, we talked about earlier. I do think, this weakness in stocks lasts for at least the rest of this week, heading on into that Friday CPI report. But I do think we get maybe the last 2 weeks of the month, last 2 weeks of December. I think you have a good chance of getting more buying support into stocks as hedge funds and as money managers prepare for next year. Okay, what else do we have? Maya wants to know about Vale. I really haven't covered Vale in quite a while. It's the Brazilian, miner. Haven't really looked at it in a while. I can tell you that obviously, if you're worried about inflation, if you're watching that inflation theme, then like I just said, those miners are going to be a good way to play it. So I would look at, that one as well as, some of the other miners. So Joseph wants to say Chinese stocks, look for SEC to compromise with the China government to change the law. Otherwise, it's risky. Yeah, we covered Chinese stocks, Alibaba, NIO, the news out of Didi that it was voluntarily delisting from the U.S. exchanges. I mean, something that would have been unthinkable just a couple of years ago when that law was passed in Congress that said if you don't comply with U.S. Listing laws and the PCAOB, then you can't list in the U.S. exchanges. And it was really a warning shot to Chinese stocks and investors in those that, over the next 3 years, they could be forcibly delisted. But at the time, it was like, okay, you know what? This isn't going to happen. These Chinese stocks, they want to be on the U.S. exchanges for that funding, for that credibility. So they're going to do what they need to do. But we're seeing that the unthinkable has changed. And here we are. Didi on Thursday night, Friday of China time, actually announced that due to pressure by the Chinese government went into Didi, said, hey, you know what? We want you to delist from the U.S. exchanges and list on Hong Kong. And so they're doing that. They're doing that under pressure from the Chinese government. And so, I don't think you can just say without a doubt that this isn't going to happen, that a lot of these other companies aren't going to delist because it is a possibility and it could happen. And in fact, that's what a lot of what we saw there on Friday with the sell-off in Chinese stocks because of that fear. A lot of reasons why China could do that, even if the U.S. wants to compromise. I don't think that the U.S. has any political reason. A lot of the politicians have much political reason to compromise. But even if they did, China with forcing those companies to delist and list over on Hong Kong, it's kind of a win-win situation for them, right? They stick it to U.S. investors, they stick it to the U.S. They get to build up their Hong Kong exchange, right, which is a fairly illiquid exchange right now. But you get some of these giant tech names listing over there, and it's going to build up the Hong Kong exchange. So it's hard to think, and plus they get more control. They get more control over these companies, more control over the economy, which is always, priority one for the Chinese government. So I don't know that you can outright say that, it's going to work itself out and that kind of thing. I did say that, I do like some of these stocks. I do like Alibaba at this point. I think you get a relief rally, a rebound off of that bad news. I think the company tries to come out and say, look, we're trying not to delist. We don't want to delist. We want to stay in the U.S. exchanges. And then maybe even if we do get kind of some talks back and forth between the U.S. and China, then I think a lot of that fear comes out of the stock, and you see a good bump in the shares. Longer term, it is still a risk though, and I don't know if I want to be in that risk longer term. What else do we have here? Okay, fixed income. Can't get something for nothing. Pretty money, keep the economy from crashing. What else? Somebody says, I like NEM. So Newmont Mining, actually the largest gold miner in the world. So hard to go wrong with size on that. If you are looking at gold prices, if you are looking for a gold miner, I know Newmont is good. I've actually looked at Great Panther Mining, a very much smaller company in the past few months. Great Panther, they had a lot of higher costs over this last year due to a lot of their production in Chile and South America there, where obviously because of the pandemic, they saw prices, production costs increase significantly. I think a lot of that comes down, a lot of that, brings their sustaining costs down this year, and I think that pushes the stock up higher. So Newmont, Great Panther Mining is probably a good one to look at as well. What else? What do you think about Workhorse? JP wants to know what I think about Workhorse. I think shit. Why am I investing in Workhorse? Now, I mean, Workhorse is a tough one. Workhorse is another one that was supposed to be so big. I got in it at right about $9 a share, right? Which I thought, compared to, I think it was up at like $40 at one point. Then it was around $15 for the longest time. I thought $9 a share was a good entry point. I still think, it could be a good stock long term. I think it's down to like $6 a share now. I mean, we could look at it. The problem with Workhorse is it's kind of an existential problem. It's kind of an existential question right now, and I do not like those questions. It's down at $5 a share right now, okay? And it's because they've pretty much had to bring back all their plans, bring back all their promises, and say, hey, we'll let you know. And so with that kind of a stock, I'm sure there is some value to the technology there, some value to the company. But right now, it's an either or situation where, a year from now, they could be back up to $15 a share, which would be, 3x your money, which would be amazing. Or it could be totally bankrupt. It could very much be totally bankrupt. So, I wouldn't recommend Workhorse right now, just because it is that existential question. Unless you're ready to basically buy kind of a lottery ticket. You're buying a lottery ticket that's either a 3x return or nothing. So you kind of have to make that decision on your own. But they have pretty much just pulled back all their promises, all their planning, all their guidance, and said we'll let you know. What do you think about? Okay, Bernardo wants to know what I think about the TQQQ for a swing trade if the Q's correct 10 to 12%. So I'm assuming so that's a bearish fund, right? ProShares Ultra Pro. So the ProShares Ultra Pro QQQ, and this is a bear. No, this is a okay. So this is a directional fund. Not sure why. Well, I mean, basically the only reason why you would use this is to leverage up your return, right? I imagine they're using options, they're using futures to benefit on the Nasdaq, the Nasdaq 100, which is the QQQ. And so, if you do get a rebound, you're going to benefit here. You're going to, you're going to get probably about 2 or 3 times what the Nasdaq does as far as return. I generally like to do my own investing instead of investing in these ultra funds. Okay, so whether bearish or bullish, I'll buy or sell options to do my own investing rather than invest in these. And one of the reasons is they're so expensive. I mean, it's 0.95% expense ratio on this fund, so it's a very expensive fund. 2 is they don't get that exact they don't get that exact leverage over time, over more than a month or 2 months or 3 months, just because, they do constantly have to be rebalancing this fund to keep that leverage position. So it is a very expensive fund to manage, and they don't get exactly the leverage. So, obviously the question on this fund is just whether you believe that the triple Q, the Nasdaq is going to go back up. If you do, you invest in the fund and you make 2 or 3 times what the Nasdaq does. If you don't believe it, then maybe you sell these or you buy put options on them and you benefit if the Nasdaq keeps on going further down. But again, I don't generally use these funds. They're much better for very short-term traders or someone that maybe doesn't want to buy those margins or the options. Excuse me. Okay. Fixed income advice. Alan wants to know fixed income advice for ARCC, BXMT, PMT. I really haven't covered these. Are these? I'm assuming these are fixed income funds, or I'm actually kind of surprised. I have no idea what these are. Okay, PennyMac Mortgage Income Trust. ARCC is another MREIT too, right? That's ARCC is Ares Capital. Okay, so that's a business development corporation, right? So those aren't necessarily fixed income. Please don't think of those as fixed income funds or fixed income companies. These are, special structure companies. So with the Ares Capital Corporation, that's a BDC, a business development corporation. They're going to be like a banker to medium-sized companies, companies that have funding needs that are bigger than what they get from their little regional bank, but they're not quite to the size where they can be listed or go IPO or get money from the capital markets. So they go to these BDCs, these business development corporations, to get loans. Okay, so these BDCs are like leveraged loan providers. The PMT there, the PennyMac, that's a MREIT. So basically, that's a company that's borrowing. It's going to be borrowing short-term rates and buying long-term mortgages, right? So these are not fixed income securities. These are companies that have a leveraged position on interest rates, on mortgages, things like that. Generally, what you'll see is business development corporations tend to do well in a rising rate environment, rising interest rates, just because they're able to make more of those loans, right? So it kind of depends on, how long dated their loans are. Most of these carry loans of 3 to 5 years duration. So they're constantly being able to roll that money over and to make higher returns, higher yields on those loans. So generally good in rising interest rates. MREITs, a little bit different, depends on really the yield curve, which I know we're getting crazy into the weeds here in the economics, but the yield curve is basically, so they're borrowing money on those 2-month terms, right? The very short end of the curve, 2 months, 3 months, whatever. And then they're lending that out. They're not lending it out. They're buying mortgages that are made on 10 or 15 years, right? So the problem here with the rising interest rates, or especially what we've seen lately with kind of a flattening yield curve, is as investors get worried that the Fed is going to raise rates sooner than expected, that short end of the yield curve comes up. Okay, and this is what we've seen. We've seen the short end of the yield curve, so very near term, 2 month, 3 month, that kind of thing, 1 year, 2 years come up very quickly, which means obviously those MREITs, their financing costs are going up very quickly. But the long end of the curve, investors are worried that, okay, interest rates are going up. The Fed is raising interest rates, especially at that short end. It's going to slow down the economic growth. So that's going to slow down the economy. Rates at the long end of the curve on the 10-year, on the 30-year bonds, on the 30-year treasuries aren't rising very much. They aren't going up. And in fact, they're coming down quite a bit. So what investors are looking at for these MREITs, these mortgage REITs, is financing costs going up, returns coming down. So not a good thing for these MREITs. I would expect that yield curve to be pretty volatile over this next year. So not necessarily. If you've got an opinion on the yield curve and whether it's going to go back to sloping, then maybe you can look into that, and those stocks will do better, those MREITs. But otherwise, it's going to be very volatile and very dangerous. Fixed income, again, these aren't fixed income companies. As far as bond investing, though, I think bonds are kind of scary at this point too, because interest rates are so low that it's hard to make any more money than you've already made on bonds. So I would look for safety in some of these other safety stocks, things like that. Okay, so yeah, Porcupine says, he picked IVR and NYMT, two M REITs as well. Got caught up in those yield traps. Yeah, that's what happens. The especially the M REITs are very, very dangerous. When interest rates start rising and falling, especially where they rise and where they fall on the yield curve. Especially lately. What else? Palantir. Sinyard wants to know about Palantir and TTCF, or is that Tattooed Chef, right? I really haven't looked at Tattooed Chef a lot. I know a lot of other YouTubers really like the stock, are really in it quite a bit, but I haven't really looked at it. It's a little expensive for my taste, but again, I am the hardcore value investor that it takes a lot to get me into some of these growth names. Palantir, we're seeing that sell off. I think in that we can check that out. A little bit more interested in Palantir because I think they've got some great technology and a strong future. But if you look at let's look at the chart. So it's held up pretty well as far as the rest of those growth stocks. I mean, it just recently kind of gave up. It looks like investors gave up since November, and it's down $7 from the $26 in November there. So it looks like investors have given up lately. They have said, this isn't the runaway to the moon growth stock that we thought it was, and it's sold off to $19 a share. On any of these growth stocks, I always go immediately to some of these basic valuation statistics, as well as the balance sheet, just to kind of see where it's at and if I might even even remotely be interested. And I can tell you, I mean, for me, again, it's hard. It's hard when I see this price to sales ratio of 27 times, and you got to understand there are exceptions to this rule. There are exceptions like Amazon, like Tesla, that perennially trade at very high price to sales ratios. I think Amazon is down further right now, but in the past, Amazon has always been very expensive on a price to sales basis. Obviously, Tesla is very expensive on price to sales and PE ratio. So there are exceptions. I mean, those stocks have done very well for investors over the last 5 and 10 years even. But you see these and 27 times price to sales ratio, 500% or 500 times plus on a trailing PE ratio. So it is just hard paying that much for a stock when I know that the Fed is pulling back on stimulus. It's getting ready to raise rates. So you've got one leg of support coming out from these, from these growth stocks, from these expensive growth stocks. You've got that liquidity, that monetary support that is driving all the money into these. Okay, so and it looks like like we saw with the chart on Palantir there over this last month. It looks like that investor sentiment, that other leg of support really is coming out as well. Investors, even on the weakness in a lot of these growth stocks, even on the weakness and sell-off in a lot of these growth stocks, it looked like investors were still supporting Palantir and some of these other stocks we'll talk about, but have since given up. They've since pulled that support away. They're going back into big tech and some of the less expensive names. So 27 times on a price to sales basis. It does look like it has a strong balance sheet. Market cap 42 billion, enterprise value of 40 billion, and what I'm looking at there, what the enterprise value is, it's the cash they have on the balance sheet. Right, so this $2.5 billion in cash that Palantir holds on its balance sheet, minus the debt, which they've really got almost no debt. $263 million is basically nothing for a company that's $40 billion company. So it's about a 2.3 net cash, okay, which is a great thing. I always like to see a net cash position with a company because obviously, if things get bad and the shit does hit the fan, then they've got plenty of borrowing capacity, right? They've got plenty of cash set aside to help hold them up over the next couple of years or to borrow more money. So it's about a $2.3 billion net cash position. And what you do is you take the market cap, which is the total value of the shares, minus that cash. So it's about a 40, and you see here, enterprise value of about 40 billion. That's kind of, coming from the venture capital world where I used to work in, coming from that M&A side of the business, that's where really what you look at a lot is this enterprise value. What can you buy this company for, which is the market cap of the shares minus out debt and, debt and cash. Okay, so what can I buy this for? If I bought the company at $42 billion, bought all the shares in the company, then I would have that $2.2 billion in cash so that I could take off what I paid for it, right? So you got a $40 billion enterprise value And that still does, and you can take that and use that for some of these valuation statistics, right? Just kind of get a price to sales, but they're 28 times price to enterprise value to revenue. This stock is just still too expensive for me. I'm not saying that it can't rebound, and not saying that it doesn't have a very good, a very good future. Like I said, I like the technology there. I think it does have some strong sales growth in the future coming up, but 27 times right now, I just wouldn't buy it, especially when you've got those two legs of support coming off these growth stocks. You've got the liquidity, the support from the Fed, and you've got the investor support coming off of these stocks. It's going to be very hard for them to do much. What else do we have here? Okay. COVID rates. I thought COVID caused the rates to be low to begin with. Detra wants to know about COVID caused the rates to be low to begin with. Not necessarily. A lot of what we're seeing right now, and especially over this last week, the rates are lower because not necessarily because investors are looking to kind of a COVID surge, but because they're looking at really economic growth and the Fed. Okay, they're looking at the Federal Reserve. Chair Powell took off his blinders over this last week and told Congress that inflation isn't transitory, like he said, like he thought in the past. He actually came out and said transitory was not a word to use for it. And the Fed was going to start talking about maybe speeding up their taper and as well as rate increases in the future. So the market saw that, kind of got spooked, and kind of thought that, okay, you know what, if they increase interest rates faster than anticipated, faster than expected, that's going to hold back economic growth. Okay, so on the long end of the curve, interest rates at the 10 and the 30 year, people are looking at that and saying, okay, if economic growth isn't as high as we thought it would be, in the future, that has to bring interest rates down because eventually the Fed is going to have to cut rates to support the economy. So that's really what we're seeing. Why interest rates are where they are right now. Okay, what else? Jeff wants to know if I like Sprott uranium. I haven't really looked at Sprott specifically. I know uranium was really big this year. We did a video on it a few months ago. I like the longer term on uranium. At one point, it got to be so expensive that it was really hard to recommend uranium and uranium stocks just because the stocks had gone up so much and it was so expensive. I would have to see it come down to better value territory though. But I haven't looked at it a lot lately. Okay, pot stocks. MM Martin wants to know about pot stocks. He's watching Planet 13 and True Leaf Cannabis. I haven't watched pot stocks in a while. I know Planet 13, kind of a retail name there, with a store in Las Vegas, I believe, and expanding into California. I think a lot of the hype has come out of pot stocks over this year. A lot of the momentum has slowed down, which is obviously, when you want to be investing in it. So you want to wait till the momentum in the prices comes down to start your position. And I believe that's where we're at with some of those. With pot stocks, I kind of like some of the other plays, the ancillary plays in those, like maybe Philip Morris, which actually owns a big chunk of, I believe it's Kronos. So it's kind of a lottery ticket, kind of an option, kind of a call option on pot stocks. You buy something like Philip Morris, you get that safe, stable cash flow from the dividend and from the traditional cigarette sales on that. And then, if pot stocks do jump, then Kronos jumps, and you get the benefit from that in Philip Morris, I believe it is as well. Constellation Brands, I believe, also owns a big chunk of another pot stock company. So, you can invest directly in the pot stocks in those companies themselves. Play the game. It's a little bit more volatile, so it's a either or kind of thing. Or you do a little bit more diversified, a little bit more safety bet with some of these traditional tobacco companies, and you still get that upside on both sides. So that's just where I'm at on those. Right now, Anthony wants to know about Marvel. Marvel, ticker MRVL. Now, I've heard a lot of good things about Marvel. You know, it's especially with kind of the weakness in NVIDIA and the likelihood that acquisition of ARM will not be approved. I know the DOJ, Department of Justice, has sued NVIDIA to block that deal, that acquisition of ARM. So I'm hearing a lot that's going to benefit Marvell, ticker MRVL. So I would be bullish on that. I think, you know, a lot of these the semiconductor and then the processor stocks, the chip stocks, are obviously going to do very well over the next few years, just as that demand for chips and that kind of thing keeps on going. Okay, so we're at just under an hour and a half on this. I'm going to close it up here. I appreciate everybody being around. I love doing these back and forths, these these live streams. So I'm going to try doing these more often. And if I didn't see your if I didn't see your question, go ahead and ask it in the comments. I'll try to get to that a little bit later on in the day. But I appreciate it. Thank you, and I'll see you in the next video.